Good morning, everyone. It's my pleasure to welcome you all. I'm Brian Schiffman, the President and CEO of the Vaughan Chamber of Commerce, for those who don't know me. And it's a real pleasure to have you all here with two leading economists, as well as a really accomplished accountant and the chair of our board, to hold a very important session, our economic summit. For a little bit of context, we tried to do this event last March 2020 in person. And unfortunately, COVID happened and everything else that got impacted. So this was the first event we actually had to postpone. It wasn't appropriate to do it in person. But we always felt, Louis and I from BDO, that it was really important to have this event and make sure we got the timing right. Personally, I don't think the timing could be more valuable than right now. As the president and CEO of the Vaughan Chamber, you wouldn't be surprised, it's a big chamber, as to what kind of questions I'm hearing from business members of all shapes and sizes, every kind of business, every industry. But I wanted to give you a quick flavor for that, as I think it might give a little bit of context. I'm going to introduce Louis and thank our sponsors. The first thing I'm hearing broadly is, when can I get the vaccine? If you've already had the vaccine, I'm hearing, when can my employees get the vaccine? Or maybe, when can my family members get the vaccine? This is all about health and safety, and obviously this drives the economy and, again, safety. The next thing I'm hearing is, when can I reopen my business? Now, that's not everybody, but if you're a business that's been impacted, a retailer, a restaurant, tourism, hospitality, you're facing different circumstances, but this is the number one thing that I'm hearing from that sector or those kind of businesses. The last one really touches on the themes of today, which is, what does the economy, where are we now? And what does the economy hold for my business going forward? Just a couple themes that'll come from that. One of them is, look at today's event. We're online, we're digitized. The Vaughan Chamber and many others have helped to pivot businesses to be online. And as we're getting more digitally savvy, what does it look for business? What does it look like for business? Will they need to do a lot more social media advertising, or will they have to remain digital and do a lot more selling online? That's one theme. We're hearing a lot about inflation. This is a concern from some of our members. We're also talking about, what does the work-life balance and where people will live and how they'll get to work. That's also another issue. Do we think that people will continue to work from home? Will they just go back to work? Or will there be some kind of mix, which is probably where we're going to end up? Given that there's a housing shortage and people have moved further away from home, how will that impact their commute? Will they want to continue working at the same places? So these are all the things that come up in the context of what the economy looks like. Give a little bit of context for today's event. So again, thank you all for joining. I want to give a few shout outs. First of all, I'd like to thank our team. The whole team at the Vaughan Chamber has been just tremendous throughout, well, from all the time, but certainly during COVID. Jennifer Rashdi, who organizes these events, who does our sponsorship and community development and behind the scenes, just an incredible job. And if you're at home, I know you're all applauding for her at home or at your computer screens at work. I want to welcome Vaughan Councillor Sandra Young-Rocco, who I know has joined us, board members in attendance. We do have Luigi Ciciretto, board chair and a partner at BDO. Louis, I'll give you a bit more of an intro shortly. Jeremy Neal, vice chair and treasurer at the Vaughan Chamber of Commerce. Nick Haifa from CIBC and our corporate secretary at the Vaughan Chamber of Commerce. Kenneth Dunkley from Best Service Pro, a very long time board member, just incredible to work with. Caroline Grech from Seneca College, also the chair of our Government Relations Committee. And Rajni Tekkerwal from Rajni Tekkerwal Law, and active on many of our committees. So it's great to have you all. Event sponsors, of course, we have BDO. I mentioned earlier, working with BDO for many, many years, and pleased that we could bring this one to fruition. RBC, thanks for being here, and Dawn, thank you. EDC, wonderful to work with you, and Peter, thank you for being here. And our community partners, York University, Seneca College, and the City of Vaughan Economic and Cultural Development Department. So thank you all. Now, turn over to Louis. Louis is going to moderate the panel. He's the chair of the Vaughan Chamber Board, a partner at BDO. He has over 17 years of experience servicing private companies of all sizes and subsidiaries of international entities. He's really worked with so many sectors, including those in manufacturing, real estate, retail, and consumer business and technology. I think gives you a great handle on today's moderation. And Louis, you've been tremendous to work with all the time, but certainly during COVID, we needed a strong chair, a great board, and a great team. And if COVID teaches you anything, it teaches you who you are and who you're working with. And I'm very proud of what the Chamber's been able to accomplish together with you. So over to you, Louis.
Thank you, Brian. Those are wonderful words, and hopefully I can live up to those during this session. Welcome, everyone. This is the, I was just trying to get these numbers straight. This is the third annual Vaughan Economic Summit in 4 years. So it's a little strange to say that. Brian touched on this, last March, we obviously didn't hold an economic summit as it's traditionally held at this time. And this time last year, I think everybody had more important matters on their minds, and just trying to understand what the pandemic actually meant this March and April. So I'm glad that we could actually do this right now, and even if it's virtual. I think we're all used to doing events virtually now and getting comfortable with those. And certainly it's not the same as being in the same room, but we'll try to make it just as good and just as intriguing. I'm happy to host to moderate this session this year, and I'm proud to be sponsoring this along with BDO Canada. And I'm actually privileged to have two panelists with me, two very distinguished economists. I'll introduce them. First, Dawn Desjardins, who's the Vice President and Deputy Chief Economist for Royal Bank of Canada. Dawn is a key contributor to the macroeconomic forecasts for Canada and the US, and is part of a team that is responsible for the interest rate forecasts for both countries. Dawn delivers economic analysis to RBC's clients through a variety of publications and presentations. She is often interviewed by media from across North America to discuss developments in the economy and financial markets. Welcome, Dawn. And as well with me, and a veteran of the Vaughan Economic Summit panelists, we've had Peter Hall on for a couple of years. Peter Hall is the Vice President and Chief Economist for Export Development Canada. Peter is responsible for overseeing EDC's economic analysis, country risk assessment, and corporate research groups. Peter is a featured speaker at many conferences and roundtables. He regularly appears in television, radio, and print media, commenting on the world economy and Canadian international trade issues. But there's something well worth noting about Peter. Aside from his weekly video posts, which I have now caught up on over the last couple of months worth, and I can tell you that they're very insightful and sometimes entertaining, as is true with Peter's delivery. But Peter is a local guy. Yes, Peter was born and raised in Thornhill, much of it before Highway 7 was a 6-lane highway. But Peter understands our issues here locally. So I'm happy to have him on our panel today. So welcome to the both of you. Brian talked about some of the hot topic questions that our business leaders in Vaughan, and I'm sure that they represent the questions that are on people's minds in the GTA and across Canada as well. And let's just dive into one of the biggest topics that has been talked about in terms of what shape the economic recovery will take. So since the beginning of the pandemic, we've been hearing a lot of letters being thrown around to depict what shape the economy, the recovery will look like. But it seems as though in the last 6 to 8 months, a lot of sources have somewhat settled on the K-shaped recovery. Given that the K-shape may have been based on a premise that things may have looked better by now, and I'll start with you, Dawn. What are your thoughts on what is the most certain letter now, and is it the best accurate depiction of what could happen going forward from this point?
Well, I do think the K-shape is actually the appropriate letter to be characterizing what we're going through, because regardless of what's happening, what we're seeing is that certain industries continue to remain under pressure. So as we have more and more cases and more lockdowns having to be implemented, there are certain industries where socially distant activities just not possible. And these are the ones that continue to be under pressure. So we have some industries, manufacturing, a lot of the goods producing industries where really within a percentage point of the pre-pandemic GDP levels. Then you look at food, accommodation, services, travel, the ones that, you know, we're all reading and thinking about, and they're down about 32% compared to, you know, where they were pre-pandemic. Now, are we all going to get back to the, you know, ultimately get back in line and see everything move back to its pre-pandemic levels? Yes, over time. But for some of those industries, you know, it's not going to happen in 2021. So, you know, the ones that are on the upward trajectory, sure, they're going to definitely have fully recovered by then. But these others, I think it's going to be a 2022 story. And in some cases, it may take even a little bit longer than that.
That's great. Peter, what are your thoughts on that?
Well, I couldn't agree more with Dawn, really. I guess I'm not on the panel to agree, but that's absolutely the way that things are working out. There are sort of three zones. There's the extreme downward leg of the K, there's the upward leg of the K, you know, and those two are really on different planets at this point. Things like food, the whole agri-food complex has really sort of had a banner experience during this whole COVID period. Building supplies are also way up in the stratosphere there. And Dawn has mentioned some of the ones that are down on the bottom. Anything related to tourism, the air carriers and so forth, way down in the chasm. Not much sign of recovery at all. And then there's this middle zone where there's a vast range of experience. And when you plot it out on a chart, really, you know, there is almost an exclusive zone for each, you know, industry at the, say, 4 or 5 digit level, right up the spectrum. So nobody's experience has been exactly the same. If I was going to, you know, do anything to modify Dawn's comments, I would say take that K and shake it up a bit, because, you know, this is a shaky K because of the lockdowns. We're back to work again, we're back into lockdown and so forth. And so we've been doing this in waves. So nobody's really been totally comfortable inside of all of this, whether you're on the high side of the K or the low side. And it's getting to the point where the tremors actually stop. And we've actually got an established letter there. That's when the bottom part of the K, as Dawn has said, is going to rush to the top. I think some of the greatest plays are actually on the bottom of the K right now, because expectations are just so low and so uncertain for those industries.
That's a very good way to agree, but also to, as you said, shake things up. So that's fantastic. You know, one of the things that we look to you for, and for you both, is just your thoughts on the overall. I know we talked about the letter and what the recovery may look like. Do you have any general thoughts, and maybe I can open up to both of you on what the and what your thoughts are, you know, on April 15th, 2021, in general. Dawn, do you want to give us some thoughts?
Sure. I mean, I think, you know, we're looking out here, and as Peter says, we're up and we're feeling very positive, and then we're down because caseloads are rising. And it is this unevenness that we've seen play out, of course, in economic output, but also in the labor market. And there are groups that, you know, are very, very, we can see it very clearly. It's clear to me that there are groups in the economy that are being disproportionately hit by what's going on. When you look at it, it is all of these industries that we've been speaking about. Another common characteristic is a lot of the workers who were working in February 2020 but aren't working now. These workers are at the lower end of the wage scale. We've seen visible minorities being more disproportionately hit, youth and women. So there are some commonalities in terms of the people the workers right now who are struggling more than others. And so I think that's something, when we think about how is this going to play out, how are we going to go through the end of the second half of 2021 and through 2022, it is really ensuring that these workers who are already under pressure, and when we even think about it, one thing the data has shown us, and this is what I find concerning, and when we're thinking about the budget next week, for example, and what the Bank of Canada is going to say, we look at, there's almost 500,000 Canadians who are now considered long-term unemployed. And so these people haven't been working for at least half a year. And of that, about 40% of them haven't been working for a year. So, that causes a lot of problems for people trying to get back into the labor market. And so I think those are the types of challenges as an economy, as we think about what's going to happen going forward, we need to be mindful of. For the government, we do anticipate they're going to continue to support these workers, support businesses, because we certainly know businesses in some sectors, it's really hard to get your head above water when you're constantly in lockdown. So we have businesses that are facing challenges, not being able to reopen. They have levels of debt that they're uncomfortable with. And on the other side of the equation, what we're seeing in some surveys, CFIB in particular, but also the Bank of Canada survey, is that companies who have reopened, they're struggling with finding labor. So it's this mismatch. We've got all these people who aren't really employed at the current time, but we've got businesses saying, we need workers, but we need workers with certain skill sets. And we just don't have them. And they're also, as Peter said, some of these businesses are facing input price challenges. They're looking, and suddenly their costs are going up quite significantly. So there's a lot of really difficult days ahead, I think, for the economy. Now, having said that, lots of support from the federal government, lots from the provincial governments, the Bank of Canada, pedal to the metal, definitely keeping support in place. And we think that is going to continue as we go forward. So although it's uncertain right now and you kind of feel nervous about the economic outlook, as vaccines ramp up, we do think that Canada is going to be in for a pretty good year overall for economic growth. Again, we're on shaky territory right now. But we think that we're probably going to see growth of greater than 6.25% this year, which is just huge. I mean, we had a loss of 5.5% last year, so take it for what it's worth. But we do think that we're going to get out of this period because vaccinations will ramp up, and we'll see a more broad-based reopening of the economy as we go forward.
Sure. Thanks, Dawn. Peter.
Well, it's sort of hard to add to Dawn's words. That was a great broad sweep of the current situation here, and clearly, right at the end of her comments, COVID is going to be the determinant in all of this. And so, inside of our forecast, we're keeping our eyes on vaccine rollout. That's a great predictor, really, of how an economy is going to do. When you look at the daily COVID data for the world, there's an alarming increase in new infections, taking us back to close to the previous peak levels that we saw just after the holidays and the turn of the year. That's an alarming about face in things, because we saw the greatest drop actually in new infections over the January to early March period of time. We've undone almost all of that right now, but when you consider the success of the vaccine rollout in the United States and the fact that they are bucking the global trend, and they've actually been able to flatten out new infections while the rest of the world is going the other way, that's very instructive that the vaccine rollouts are really primordial when it comes to economic recovery. But that's twinned together with other things. Certainly, we've got to keep our eyes on governance. And that's not going to escape any political leader, as we walk through this year. And thirdly, herd immunity. So the combination of these three things actually coming together to create a situation that people feel safe going out into. Now, if I were to add anything, sort of substantive to Dawn's excellent explanation of things going on, I would rewind back to pre-COVID and say, look, What kinds of conditions did we actually have? And this brings sort of a word into the discussion here that you don't always find economists talking about, and it's hope. Where are our hopes? Where do they really lie? How do you deal with the hopes of those in the long-term unemployed who have really been dashed? Well, this isn't a new thing, because in the post-global financial crisis period, folks that were graduating from their education programs back in 2008 had to wait up to 7 years to get their first meaningful job. And so this is something that has really infected our thinking, and I think is a critical part or a critical explanation as to why there are populist movements, not just in Canada, not just in the United States, not just in Western Europe, but all over the world. The economy has really failed to generate the opportunities and to inspire the hopes, particularly of the young generation, but also of these cohorts that Dawn mentioned. And so COVID is another sort of big slap in the face to a situation that we came into this with, which really had dampened our hopes. Now, how do we turn that around and say, well, what is the economic context for that? Well, our strong belief is that we came into this COVID situation not like the pre-global financial crisis period, where we had a massive bubble in the world economy. And, the financial crisis really was the needle that came along and burst all of that. When we came into the COVID period of time, we had an anti-bubble. We had very strong evidence of pent-up demand in Western Europe and in the United States. Not so here in Canada. So that sort of put blinders on us, perhaps. But when you have a situation of pent-up demand, well, there's nothing that fuels hope more than knowing that the economy is ready to launch out in a period of almost unfettered growth. Now, one might look at unemployment rates that we had just prior to COVID and say, you're out of your mind. But when we look at the underinvestment that happened for a protracted period of time, we had a heavier dependence on labor than we otherwise would have had. Investment was trying to catch up. So in our view, there still is that economic impetus. And that's frankly why we saw consumers get back on their feet so quickly. 2 months down, 2 months right back to previous, to pre-COVID levels of activity. So hopes may be dashed, but the fundamentals in the economy are juxtaposed with that in a way that I believe, when we get the green light, we're going to be ready to go.
Yeah, that's fantastic, and hope, that message of hope is good to hear. And both of you touched on some really good topics that really follow through with some of the planned topics that we wanted to talk about today. And so that's I'm glad that we're all on the same wavelength right now, and I want to capitalize on that momentum. So Peter, I'm gonna ask you about something that Dawn just touched on. She brought up the federal budget. So the federal government's first post-pandemic recovery plan set to unveil on Monday. It's going to be the government's first budget in more than 2 years. A few key issues to unpack there, including, and there's a bunch, but I think we'll focus on a couple of them. It could be its own event probably, but let's talk about financial stimulus, childcare, climate change, things of that nature. I think everyone's concerned about the stimulus and how much, and can we recover from all this debt that continues to accumulate. Ms. Chrystia Freeland has already indicated that the government will be spending between 70 and 100 billion in stimulus over the next 3 years, and that's probably the theme of what we're going to be hearing about come Monday. On everybody's mind is, what's going to happen with all this debt. Can you kind of take us through that?
Sure thing. Well, until we actually get through COVID and, the green light is on for the economy and we're getting back to more normal activities, the focus of fiscal policy right around the world, not just here in Canada, is going to be on getting us through this thing. That has been game one almost from day one, and that is set to continue. We've had no hints that the word austerity is anywhere in anybody's vernacular. Fiscal fiscally at the moment. It's the push to make sure that past investments pay off by continuing that until we get through this thing. Now, I think we can safely bet that the our federal government has its eyes on the K-shaped forecast as well, and particularly those companies at the lower end that have really been trying to keep themselves going day to day, week to week, or what have you, keeping the lights on so that when the economy does come back, they continue to be viable businesses, supplying us with all the goods and services that they did before. Now, an example of that is really the monies that were provided for Air Canada. And of course, when one particular company or one particular industry actually gets particular attention, that can actually rub people the wrong way. Let's think about how important an air carrier is, any air carrier is to an economy. And certainly we want them to be around by the time we get out the other side of this. This is an industry whose benefits extend to just about every other industry. And so very important to make sure that that's the case. And Canada's not unique in this respect. Any country wants its air carriers to be viable by the time we get out of this thing. And of course, these are industries that are deeply down in the chasm at the moment because of the lack of travel. You mentioned childcare. We've already got hints that COVID has illumined some of the gaps inside of childcare. And in the words of the finance minister, this is an opportunity to redress that. And of course, in the Liberal convention recently in the last weekend, this was a profiled area of spending. Okay, so so much for what the intentions may be. What does this actually leave us with? Many are looking at the accumulation of debt, not just here in Canada, but around the world, and saying, what have we done to ourselves? We in the past, we could remember here in Canada, rewind back to 1990, when we tumbled into a very deep recession, and Canada's debt to GDP ratio went from somewhere around 65%, and it was moving in on 100. And the ratings agencies, turned the red light on, and the Liberals wrote the big red book to address the red light, and everybody was sort of scrambling. The Reform Party came out of nowhere, and everybody was talking about austerity. And of course, there was a wave globally of austerity over this period of time. Well, if a debt threshold of 100% debt to GDP was the trigger for that kind of thing, I'm afraid the OECD has put Canada now way above that level. Their projections for 2022 have us somewhere between 130 and 135% of GDP, and we're right there with the Americans, and most others have seen the same kind of fiscal deterioration. So this isn't something unique to Canada at this point in time. And really, the task is going to be, how does the world address a massive and almost ubiquitous increase in debt to GDP as we go forward? Well, I got to leave some room for Dawn to talk about this, but just one thing to close us off. There are new thinkings going on about how to manage these debts, buried in modern monetary theory. I would say, this is very experimental at the moment. Nobody really knows how this is going to turn out. And we've got to keep our eyes very much on future tax liabilities, how it is that we're going to generate the revenues that help us to stabilize a situation like this, and how we're going to prepare ourselves for the next downturn in the economy.
Dawn, do you want to add some comments?
No, I think Peter's covered it very well. We are looking at the $70 to $100 billion spend, which, goes from the idea of support, which obviously the economy is needed as we've gone through COVID-19, whether it's support to businesses or to people who've lost their jobs. And probably those supports will be extended to some degrees, because some of them are going to expire in the middle of June. And then we look at, okay, the next step. So what are they going to announce in particular with respect to childcare? And, we've done a lot of work on this issue. In fact, spoke to the chamber about this recently, that women have been disproportionately hurt during this economic downturn. And certainly women with children, being, leaving the labor market completely in some cases. And we think about, so, why does it matter? Well, it matters because we need our labor force to be running at full tilt, if you will. We're an aging population. Certainly to the extent that portions of our labor market step back, that really does damage the ability of our economy to grow. One statistic I like to share because I find it personally so impactful, when we look at women's participation in the labor market, it had been going up. It was a big source of economic activity. We've seen the gap widen a little bit. But when we look at it, if women participated in the same level in the labor market as men, that would add $100 billion to GDP every year. So, to me, it's kind of like, okay, so the government now is looking at how are we going to support the economy as we rebuild, or as they call it, build back better, having some kind of childcare in place. And it's a mucky situation, right? It's not really in the federal purview. It is the provincial purview. So how do we develop a program that will allow women to fully engage in the labor market and ensure that we maximize our standards of living and our economic output? So, there's a lot to unpack, and it'll be interesting to see exactly what the government comes up with on Monday and how they intend to, shepherd this through, if you will.
Yeah, absolutely. I think we'll all be sitting on the edge of our seats. It'll be an interesting one. Let's just touch on something that Peter touched on as well. In terms of inflation, not only from a commercial standpoint, even on a consumer level, anybody who's been doing home renovations has been shocked to see the price of materials. And then also on the commercial side, supply chain and the cost of inputs has really skyrocketed. You want to think about that as well as, the whole Trump administration and Biden as well with the Buy American and thinking about how Canada can compete with that. Can you help us understand, Dawn, how that plays out for Canadians?
Well, I guess on the inflation front, certainly we're kind of in the high inflation spot right now, simply because some of it reflects, what geeky economists call base effects. Prices were falling a year ago, in particular for energy prices. And so when you are facing that in a calculation, the math just pushes the level higher when prices are actually normalizing or rising. And so we do think that in the near term, people should look for inflation rates which are above the Bank of Canada's 2% target. We think it's probably going to be somewhat short-lived because we do think that there's still slack in the economy. Now, that, there is a risk, however, that all of these input price increases that we're seeing have to be passed along to consumers. So that's certainly, I would say, a risk to the outlook that, in fact, that this higher level of inflation, probably is going to ease up a bit, but you may see some pass through of these higher input costs to consumer prices. And that we'll be monitoring through looking at measures that are not that headline, but take out some of those volatile components like energy, because that tends to skew the math, I guess I'd say, on the inflation rate. Now, when we think about the fact that there is some excess capacity, but that, over the course of the next year, we're probably going to eliminate that spare capacity. So does that create some upward pressure on inflation? Well, what we've seen recently is that inflation expectations, as indicated by markets and by surveys, have crept up a little bit, but they still remain relatively well anchored to that 2% target. And really, I think that's the key when we think about how inflation pressures, businesses will pass along some of those costs. Will workers say, okay, I demand more wages, therefore, and that's what starts your more sustained inflationary cycle. But we do think that, that probably will be a short-term thing. You could get it to 2% on a sustained basis, and that really is what the goal is. We also think that the Bank of Canada quite likely will be moving interest rates up sooner than they've communicated recently, because the forecast that they were basing that idea on, well, it's proven to be a little bit shy, a little bit weaker than the actual economic activity. So, all to say, inflation could be higher than it has been over the past decade, but we don't think it's going to burble out of control, because we think the central bank will be active once the economy's back in full force.
Peter, anything to add?
Well, no, not really. I think our views are very similar on this. What I would maybe chime in with is that, look, as painful as it is, it's easy to shut an economy down. We've demonstrated that, in 2 short months, an enormous drop in overall activity, which was essentially a policy decision around the world, and so it shut down. It was very effective. It was very painful. Getting it going again is another matter altogether, and especially in the current context. So you can have orders, but if your supply chain is taking a while to actually get up and running again, and we might ask ourselves, well, why would that be the case? People want to work. Businesses want to turn the lights back on again. Yes, but in an environment of uncertainty, that doesn't happen as efficiently as we might want it to. First of all, with labor, do people actually want to stand on a factory line or go back into an office space or go down into a mine shoulder to shoulder with people whose health situation they're not exactly sure about? After all of this, nobody wants to take any chances. So the reluctance of workers to actually go back is a factor inside of this. As much as they need to get their paycheck back again, there is that health concern that's actually there. In terms of getting things going again from the business decision point of view, after all of this uncertainty, cash flow has become critical. And businesses saying, well, I'm not so sure that the orders I'm seeing now are going to be sustained. What about the next wave of infections? What happens at that point? And so businesses are tentative, saying, well, let's come back a certain part of the way. And businesses would always like to be behind the curve, because if there are more orders coming, well, then I'll make a decision at that point in time, but I'm not going to compromise my cash flow right now by getting out there and opening up 100%, only to find myself getting shut down again and having to let all my workers go back home and so forth. That's a very costly and painful exercise. I'm not going there again. And so that's what causes these short-run inflation problems at a grassroots level. And it's getting over that period of time. It's not, as Dawn said, like we don't have the capacity. We had lots of capacity pre-COVID. We're not back up to full capacity yet. So that's what ultimately keeps price pressures at bay. But it's getting to the point where we are back up to those capacity levels that isn't a straight line. And so that's sort of the dynamic of it. Now, as Dawn said, if we can keep expectations to the 2% level, then we can work through this temporary period of time. If expectations get out of control, that's a danger point. That's when central banks actually have to get active and bring what would otherwise be known as punishing monetary medicine to get those expectations back down to a level where our prices are nicely governed. Last thing I'll say on this, Louis, is that I'm keeping my eyes on things stateside, because the labor movement was key to pushing Biden over the finish line in the US. And the labor movement always asks for we all ask for some kind of payback. If we're the key mover inside of somebody's political campaign, well, we're hoping that something is going to come back to us as a result of that. And my worry there is that the sense that there is a need to redress wages in the labor side of things falling behind the times, and we need some catch up there. Well, that's where, as Dawn has said, those factors become more persistent, and it's harder to tame them down as we go forward. And that's what we call cost push inflation. You get into some kind of spiral there where labor wants more. It's got to be factored into margins. You pass those prices on. Goods cost more. People then in the rest of the economy want to be compensated for that in terms of their real wages, and so on. It becomes a bit of a spiral. And I remember, well, I'm old enough to remember the 1970s. I was still wearing short pants then, but I was sort of traumatized as a kid by all of this talk about inflation fighting and wage and price controls and so forth. The things that we tried to keep that at bay. When it gets out of hand, it can be a bit of a beast. Now remember, like this time, back then we had a period of very low and stable prices leading up to it, and all of a sudden we had inflation pressure. So there's nothing magical about the fact that prices have been tamed for the last 30 years that's going to ensure that we don't have inflation problems, and central banks are being very vigilant about that right now.
That's good, good insights, and good advice, and good that you guys are on the same page. I'd like to steer the conversation to, and something that you guys both touched on is the hardest hit industries, and you kind of touched on airline travel. I want to bring it into small business as well, a little bit of hospitality and tourism. Peter, you did touch on Air Canada. I've heard it best put that airline travel pre-COVID was getting more affordable for everyone. Air travel, hospitality, and tourism internationally was booming, but we've seen a lot of smaller airlines come up with some innovative ways to bring that cost down. But then those disruptors were disrupted. Now we've seen the Air Canada deal with the federal government. Do you think, what's your outlook for help with the other airlines, and then how does that trickle down to help the rest of Canada's tourism economy?
Sure. Welcome Dawn's thoughts on this as well. But putting this into context, we might well ask ourselves the question, well, I really don't know whether other airlines are going to get the same kind of bailout. I'm not in the business of sort of guessing what is going to happen. They all need the help. There's no question about that. But I think the more fundamental question is, are we going to fly again? Like, are we actually going to go out there and get ourselves into that aerial virus tube, sitting shoulder to shoulder with people in very close proximity? Do we have the sort of psychosis to be able to do that properly? I don't know. I've wrestled with that as an economist. But what we found as we did informal polls of our key clients across the country last fall, and then as we worked with our financial partners in the early spring, we asked them, look, let's just go around the table. Tell us what your big obsessions are right now. What's keeping you up at night? And number one was, of course, getting through COVID. So that really wasn't much of a surprise. But number two was a real surprise. The number two issue that was raised by them was, when do we actually get to do people-to-people business interactions again? And I was floored by that. I thought that was going to be somewhere on the list, but certainly not a very decided number two. There was nothing close to it, really. So why is that the case? Well, I asked them, I said, okay, tell me, why is this so important to you folks? They said, look, we can't do a merger or an acquisition, a big one, without actually knowing the people that we're dealing with. And that's not just one person-to-person meeting. We've got to have a bunch of those before we're actually comfortable with what's going on. Zoom doesn't cut it when it comes to that kind of thing. Are we going to ink a big, export sales deal without being able to do some person-to-person inside of that? Well, digitally anything can happen. We don't really know what the person on the other side of the screen, if they're the person that we should be seeing or not. It doesn't quite work that way. If we didn't have a relationship beforehand, it's very hard to establish that kind of trust over the wire. So we really need to be there. And then businesses flipped it around and they said, you know, there's another aspect to all of this. We buy very expensive equipment. And of course, COVID has jolted us into doing more of this because we need to digitize, we need to robotize, we need to be employing artificial intelligence because with the lack of people to people at the ground level, well, we're depending more on machines. And so it's jolted us into saying we need more of this. And so we're actually doing it. Some businesses were saying we're actually doing this. So we got a very expensive piece of German manufacturing equipment here, but we need the specialist to come and help us to integrate that into our system. And that specialist is not going to put up with a 14-day quarantine here, 14 days when they go back, a month away from their family, the risk of infection when they're actually in an airport or in an airplane. You know, they're not there. That has been shut down. All kinds of business services that require cross-border people movements have been compromised by this. And businesses have actually told us, look, you know, we've got orders. We can't meet them because we can't amp up our production. And it's people-to-people movements that are keeping us back. Okay, so sorry, that was a long story to get back to the airlines themselves. But if this is what business wants to do, if they actually want to get back into airplanes and have these person-to-person movements, then there's impetus for that. They're not going to go forward until they get the green light to do that kind of thing, but they're going to wash in there really quickly. Now, how does that impact tourism? Well, the average person, when they see that the average business person is ready to get on an airplane and go halfway around the world to do something, might think twice about keeping themselves cloistered inside of their house if the doors are opening up again, and that's something they can do. Well, the demonstration effect of business travel is going to lure them back in. Airlines are also going to want to fill their airplanes up and watch. I mean, it's already happening. Deep discounting is going to be another alluring factor that bring people back into this space. So my bets are that we're going to have pretty full airplanes, let's say, you know, by the end of this year, early next year. And I know that's a bold prediction. That seems like, you know, another world from now, but we saw it happen in previous virus incidents. And when we know that the willingness is actually there, that's going to be the case. Okay, so do those fiscal payments to airlines actually pay off? Absolutely. Under that scenario, absolutely.
Thank you, Peter. And really interesting way to bring it back to hospitality and tourism. You know, you talked a lot about I would say international tourism. Don, I'm going to turn the tables a little bit and talk about domestic hospitality tourism and what that looks like for the Canadian economy. And a lot of sources have been saying that what's going to accelerate the Canadian economy, especially for the hardest hit sectors, would be for domestic travel to really ramp up. And it seems that from the travel enterprises that I've been talking to, that's sort of it's a hard nut to crack to get Canadians to travel within Canada. I know there's, you know, given COVID and interprovincial borders that are closed. What do you think we can do? What do you think Canadians can do or Canadian businesses can do to try to convince Canadians to see their own country or to help the Canadian economy in this way?
Yeah, I mean, because one of the things that will drive our economy as we finally become vaccinated and reopen on a more sustained basis, even if it's not international, is the fact that households right now are sitting on hundreds of billions of dollars in savings. I mean, some of it reflects the fact that some of the people who have received income replacement, you know, they're getting more than they would have had working. And I would say some of that savings is more precautionary. These people are worried, you know, how long am I going to be unemployed? So that necessarily won't be the driver, but it's the households that maintain their job. These are the higher wage households, or in fact seen employment gains. And again, that's on the higher wage end of the scale. These people haven't been able to spend that money. You know, yeah, you can buy things, some goods and have them delivered to your home, but in terms of services, you can't spend it. So there's a lot of pent-up demand for all of this. So, arguably, we don't know when international borders are going to open. I think once we have an more elevated level of vaccination, and to be sure, I mean, Canada has been lagging on the vaccination trail compared to the US, the UK, where much more widespread vaccination has occurred. But the government has said, people who want to be vaccinated by Canada Day, should have had at least one shot. So to me, that does open up on a more sustained basis parts of our economy, including some of the closer contact industries, like going out to dinner, traveling. So to the extent that there's a big pot of money just waiting to be spent as people look to, kind of get out of their own houses, it does suggest to me that that will be at least a first course of action, because I do think, as Peter said, eventually people will be more confident and travel the world. But that's probably going to take some time, be more confident, I think, traveling within your own country, at least initially.
Well, one thing I can add to that, Louis, if I may, is that, RV sales were just exploding last year. And so as an indication of people doing more local travel, indeed, they're doing it in a different way. They might not be staying in an Airbnb, but, campsites were at a premium. That's the kind of thing, there's a different manifestation of people traveling locally. And, I'm hearing now that, the subscriptions for RVs have been high. You can't get one for love or money at the moment. And so it seems to be continuing right now. People want to do this kind of thing, and this is the only way they can. So they're saying, look, we've got dollars there for domestic travel, but we're confined in the way that we have to do it right now. So this is how it's manifesting itself now. When the doors open up again, there's every expectation that we're going to be back to, doing the kind of exploratory travel, Airbnb and so forth, domestically and internationally when we get to that point. Sorry to jump in there, but I thought that was a point that has really stood out to me.
Absolutely. No. Please. So I wanted to dovetail that into the Canadian economy remaining competitive, trying to accelerate itself. I want to turn it a little bit to the job market. I know that, Dawn, you've mentioned that a couple of times. We do have, Brian had mentioned a couple of community sponsors that we have in attendance actually today, York University and Seneca. I want to talk about credentialing. In terms of small businesses being the hardest hit sector, we're trying to remain competitive. There's been a lot of talk about micro-credentials and what that can do. A lot of trade organizations, learning institutions, and even some of the larger employers are getting involved in that. What's your advice on that front in terms of boosting Canada's domestic production?
Who are you throwing at that first, Louis?
Sorry, Dawn.
Certainly, when you think about it, it will speed up job transitions. And that's where we're at right now, where people, have certain skills. And we've done a lot of work on this just a few years ago. We were looking at it in the context of, what are the skills that people have as we knew we were going to be moving to a more automated job market. That was probably, the 10 years it was going to take happened in 10 months, but, we knew that was happening. So we were trying to look at, so what are sort of some skills components that people who were at higher risk of having their jobs automated, what are those common skills that they have with other positions, which will be jobs of the future? And I think this micro-credentialing is really a step towards doing that. You have a certain skill set, but you need to grab a few more skills to be able to take on this new position that is in higher demand. And certainly, we have seen that. I know that even RBC has a program where, if people take a suite of courses, they get up to a certain level that allows them to be sort of in that pool of workers that we can draw from. in order to fill vacancies as they come up. Being, a more digitally enabled bank, we need to have some of these digital skills, so people are able to do that. So I think, this is something, a wave that has been accelerated, and certainly is one that is necessary, because sometimes you don't have to, recreate every skill you have, but you need to have just these augment your skill set. And I think that this is a very good way of doing that.
Well, even for the female workforce, you touched on females in the female workforce in your earlier talk. I think the stat there is that there's only 4% of national skilled trades are women. So that might be a way to sort of accelerate that if women take more of an opportunity to get those micro credentials.
Yes, certainly. And so, looking at skilled trades, there was a significant increase in women who were moving into more male-dominated skilled trades. So we saw this migration. And over a 10-year period, so that 4% of women moved to something closer to 6% by 2019. So certainly, moving the dial, having women move into the more male-dominated, because certainly in the skilled trades that women are dominated in, whether it's personal services or food, that's one thing. But now moving over towards more of the male-dominated skilled trades is something that, manufacturing roles, construction roles, that is happening. But again, trying to get people moving to jobs, it's a climb. I mean, it took 10 years to move just a couple percentage points in terms of the total. So, but opening the doors, making things available to everyone, to a more diverse labor force, I think is going to be instrumental to get women participating in the labor market to the degree they need to.
And I guess any discussion around jobs and accelerating the small business and the competitiveness of the Canadian market wouldn't be complete if you're not talking about the impact to the housing market. So I'm going to turn my attention to that. I know there's been a couple of questions from the audience, so I think it's a good time to bring that in. In terms of this housing market, I'm going to call it the crazy housing market. Peter, I'm going to ask you about this. Can we continue to use the word bubble? I mean, what's going on? Can you help us understand this?
Yeah, how does one put the housing market into context? Well, I think we always have to go back to a question of what the fundamentals are. And I'm not trying to put everybody to sleep here, but demographics are about the easiest thing to predict in the economy. It's almost as simple as, next year we're all going to be 1 year older than we are. Babies are going to be born, and unfortunately people are going to die, and it's a very smooth movement through the economy. Well, if we can actually take the cohorts of that very slow moving demography and say, how can we characterize the housing market? So where are the new purchasers? Where are the ones that actually are the owners of the existing housing stock? And how do we account for people who are passing away and sort of leaving spare units there? Well, when the Bank of Canada did their analysis on this a number of years ago, they said, well, sustainably over time, it's about 185,000 starts. Well, we're up in the 230s, 240s right now, and we've been way up in that stratosphere for a long, long time. Now, Canada's housing story has been very different from the American story, and this dates back to the early 1990s, really. We had a jobless recovery. The housing market was very, very low at that time, and people were calling it a new normal, and then it came rebounding back and so forth. We got out of sync with the United States then. And so typically in the past, we would say, well, if they've got a bubble, we've got a bubble. And let's just call it that. We're going to move in sync with them. Well, that didn't happen at the global financial crisis time. Because we were still making up for lost time. So we came in with the same kind of stimulus, and our housing market really picked up on that. And so stimulus for the macro economy can sometimes have unintended consequences. And I think there's an acknowledgement by the Bank of Canada, or at least its former governor, that monetary policy has sort of overdone things for the housing market, but it was very needed to keep the rest of the economy going. And so, I think we very definitely do have a bubble. And, some people used to say, well, that's just a Toronto and Vancouver thing. Well, there's a funny thing about housing markets. If you're sitting in Toronto and your house has doubled or tripled in the last number of years or what have you, and you come from somewhere else, and that's where your family are, and you'd really like to go back there, and you can sell your place in Toronto and get an enormous cash stash from that. This is the biggest windfall in your life. And you wander off to your smaller place and you can live in a mansion there. Well, you're going to do that kind of thing. You're going to do that, bank the rest, live off it, or try to find a job there. Economically, you can be very equivalent in a situation like that. Well, we've seen the major centers have that effect right across the country. And so we've got a bubble, we've got an exported bubble right across the country. And that's not great news because, all things like that have to come to an end. A bubble is a very, very fragile construct. You don't need much to come along to take the air out of it or to see it disappear completely. And so unfortunately, with all that is going on in the rest of the economy that is positive, this is not one that I'm particularly keen on at the moment. I'm quite nervous about where our housing markets are at right now. And I think I sort of share some of that space with RBC. David Rosenberg has been on the airwaves for the last long while talking about how precarious situations are. And I'm really very much in the same camp.
Yeah, and as Peter said, we are having housing starts at high levels, but having said that, the supply side of the story is also problematic. We did see in March a huge increase in supply being put in the market, but the appetite for housing right now is voracious. We look at, as we talked about, that savings pile. We've got very, very low interest rates. And the pandemic has created a situation where people do want to move out of the city. They do want to sort of take that cash out of that asset and move out. So then what happens is they put pressure on all of the other smaller housing markets. This towns and cities, right across the country come under pressure because they don't have the supply for all of these people who say, oh, it's going to be remote. I don't have to worry about going into the office on a regular basis. I need more space. I can't really be in this little unit anymore. I need to have somewhere where I can go outside and walk around. And as a result, we have seen this just significant upward pressure on prices. Sales are at record high levels and prices are running on average 20% higher than a year ago. I mean, it is quite startling. So over time, what seems logical is that we will start to see interest rates move up because the economy will get back to full capacity. The bank will be, realizing they don't need to have pedal to the metal anymore. And affordability conditions are just going to price some households out of the market. And right now, we're doing this even without immigration really happening because of the borders. So once immigration starts to pick up, that's going to be a balancing factor in there as well.
Yeah, but one of the things we can say about that, Dawn, and I think we can agree on, is how on earth do we have this frenzied housing market when we saw immigration absolutely plunge? I mean, that makes me even more fearful about what's going on at the moment. Now, clearly, some people are buying second homes, second properties because they just want the space and so forth. So there has been a net increase in, let's say, our requirement for housing. But, with no more people, and in fact, with very much fewer people in the past year, I still think, wow, even when we solve for all of those factors that might explain, I think they only explain a portion of what's going on. And I don't have a metric on this, but when a price is going like this, it's very hard to resist speculating in that marketplace. And so, I don't have a survey that I can point to. I don't have anybody else's analysis that I can point to, but every time you see something going north in a hurry like that, You know that there is speculation. You just have to scurry around and find out what the source of that actually is. But I think that that's part of what's fueling things that are going on right now.
Absolutely, and I think it's already 10:06, and we've been flying through a whole bunch of topics, and I've been finding it very interesting. I think we've been having a lot of questions from the audience. Some of them, as they've been coming through, have been answered, but I think I'm going to turn to some of those audience questions for the last half hour of our session now. And the first couple of questions I'm going to group into the similar topics, but the first question is about the arts and cultural industry. The question is, will we continue to have concerts, events, etc.? How will this industry survive? And I'm going to tag that on with another question in terms of tourism, which includes conferences and in-person meetings as they drive the economy. So, Peter, I think there was a comment that you made about that not necessarily being that important to drive the economy, but let's talk about concerts, conferences, and that sort of that realm.
Sure, and Dawn and I are both sort of veterans, I guess, of speaking at conferences all over the place, and so this is a space that we sort of know more than just as economists. So what do we see actually happening here? Well, let's put the numbers on the table. Arts and entertainment is an industry that dropped by 50% and stayed there. Virtually no movement, no upward movement there, and so. Putting it sort of in boldface here, let's just say that there's a 1-to-1 ratio between that and employment inside of the industry. So half of the people that were specialists and gainfully employed now don't have a job. So think about people who are graduating, coming into their own in arts and entertainment, trying to crack into that marketplace. They're competing with 50% of the market who already have experience there. I mean, that's just a dire situation for them. Okay, so is there any hope for them going forward? Well, I go back and say, man, I wish a year ago February, I had bought Netflix stock, or I had bought, the stock of Spotify or what have you, because we've transferred our need for entertainment over to the digital side, and those stocks have exploded, and of course usage rates are really high, and so our appetite is still very strong for that kind of thing. It's just manifested itself in a different way. So if the appetite is still there, that's the best indication that when you can actually go to a live thing as opposed to looking at it over this, let's face it, there is screen fatigue big time. Like, we are all like, those days where you have sort of 10 meetings behind a screen, and then of course you've got your charity board that you sit on, and you've got a board meeting in the evening and so forth. It just seems incessant, right? And you're talking to some friends and so forth, and maybe that's the only way. Family members you communicate. So our days are wall-to-wall digital, and I think that people are really beginning to say, okay, it's nice, it's efficient, it's not going to go away when we get on the other side of this thing, but I desperately need to do things in a different way, and those person-to-person interactions are going to be. I think that's as true for arts and entertainment as it is for other parts of regular life. And so I don't see us cloistering ourselves and being worried about going to a hockey game, or by the same token a rock concert or a symphony or something like that. Once we see that it's safe to do that, and that others are coming back from those things and they're not contracting diseases and so forth, well, we're going to congregate in that way. The infrastructure is still there to do that. The providers still want that to happen, so they're going to do their best to lure everybody into that. Same is true with business conferences. Virtual trade show floors are effective. But they were tried a number of years ago through wonderful digital interfaces that could have you actually walking through as if you were on an actual trade floor. I don't think there's anything like being able to walk up to a booth and touch the stuff that you're going to buy and meet the people who are actually selling it and having a person-to-person discussion with them. And all of the folks who run those older style, the analog trade shows, and the people who participated in those, as far as I can tell anecdotally, are very, very willing to go back to that way of doing things. So I do believe that there is going to be more of a return to normal than is expected now. And certainly the industry is going to try to get us back to where they were before, because they've been suffering with the lack of revenues over time. Sorry to wax on about that, but I think it needed a bit of a buildup there to sort of pull out the logic.
No, for sure. And you touched on something. Would you agree that you touched on the in-person trade shows? Would you agree that that's been one of the continued concerns for Canadian exporters in terms of not, and being from Export Development Canada, I know that you have some insights here, but would you agree that those are some of the biggest concerns for them, not being able to actually go to those trade shows or participate in those in-person trade shows?
Oh, I think so. It's not just those who provide those services that are worried about getting them back up and running again. It's those who are really trying to display their wares and have people try and test them out. There's nothing quite like physical demonstration to do that for industries. So that's what we're hearing from them. And in fact, our customer base is saying, we know that there is demand out there. It's still very strong. We need, to get back to doing this kind of thing so that we can play in that game. Otherwise, firms are just going to go with the tried and true. If they're using a brand of equipment, they're just going to repurchase that and so forth. The competition is perhaps being a little limited by the lack of physical demonstration capability.
Thank you, Peter. There's been a question about interest rates. Dawn, I'm going to turn this over to you. The question is, interest rates will go up eventually, and you did talk about that. How will this affect bonds, which have very low value right now?
Yeah, I mean, we do think the Bank of Canada will be raising interest rates in 2022. So probably in the second half of next year. We've already seen interest rates move up because of these inflation scares. Inflation rates are higher, and as a result, we have seen bond yields move up quite significantly, and they have increased more rapidly than we would have anticipated. But we think they'll level out here as we go forward, because we think this inflation sort of scare, if you will, will moderate as we go forward. But for the Bank of Canada, their current position from what they've said, and again, next week we're going to get an update, and I think we will see a significant upgrade to their economic forecasts and assumptions, and therefore it could change the timeline. But, previously suggesting that they were going to have rates on hold until 2023, because it would be at that point, all of the output gap, the amount we're running below where we could be using all of our capital and labor, wasn't going to close until 2023. And therefore, inflation was not going to move sustainably to 2% until that time. Well, growth has proven to be more resilient than the bank had assumed. They were looking for an actual contraction in economic activity, and it looks like growth in the first quarter, it looks like growth is going to be 6-7%. So that's just setting the stage for the bank. And so therefore, we think that they're going to acknowledge that most likely. Now, this is an uncertain outlook, so we layer that on, of course, as well. But we're going to see that output gap being eliminated sooner than the Bank of Canada had previously thought, and so that will open the door, to our view, to moving them from that dead low 0.25%. But they're going to be cautious. They're going to move slowly. And so interest rates, we only have a 125 basis point hike next year. So, this is like a very long, prolonged story. Do yields move up? Yeah, they move a bit higher, but not significantly compared to, they're going to remain historically quite low in our view.
Thank you, Dawn. And just to follow on that, there's you were talking about inflation, what the federal government has lined up for, perhaps the Bank of Canada has lined up for us. There was a question about the budget and our spending. Given that it's been 2 full years since the last federal budget, the question is, what is the total, the running total of the deficit since the last budget?
Well, we think that for the fiscal year we just completed, the number is going to be something like $360 billion, which is a big number, admittedly. And as we go forward through this fiscal year, our estimate right now is about $150 billion. So, we're going to be running significantly high deficits because we continue to require these supports to keep, households, workers, and businesses solvent enough to get to the other side of the crisis. Those levels will come down simply because we'll be growing, tax revenues will be rising, not because tax rates necessarily go up, just because we'll be generating more economic activity and revenues. And those costs, those spending numbers that we have to get us through this period, they of course are going to come down significantly as we reopen. So yeah, we're in the hot zone in terms of deficits. But as Peter remarked earlier, Canada is not in isolation doing this. This is a global pandemic. Governments across the world have significantly had to increase the amount of spending to ensure, they had to fund all of the medical side of the equation and keep their businesses and their households, solvent as we go through this. So, things will look brighter. Again, looking at that $70 to $100 billion over the 3 year, that stimulus spending, that again, what does that look like, and how elevated does that keep our deficit levels compared to where they otherwise would have been? This is a thing we're mindful of as we look forward.
Mm-hmm. Thank you for that. Question here, and I'm actually on this one, I'm actually not sure as to who's going to take this one. I'll throw it out there. How will the current microchip shortage play into the continued sales in the auto sector?
I don't mind giving Dawn a little break here. So the auto sector has been a phenomenal one. If I could paint a chart of actually what has happened since COVID, it had a unique experience. No other industry in Canada had the same kind of experience as the auto sector, because in GDP terms, the auto sector dropped 91% from pre-COVID to the trough. And that's, you can only drop 100%, right? So you're going most of the way there. We looked at that and went, oh boy, as Canada's export credit agency, we've been called on in the past to help bail out the auto sector. So in the pre-global financial crisis period of time, and then when the crisis hit, there were a couple of different times there where the sector was in deep duress. And, an initial instinct would have said, are we back in that space again? Are we in bailout zone? And there was no industry that recovered as quickly and as rapidly, as dramatically as the auto sector. Now, it's a real head scratcher, because when the bottom drops out of the economy and you've got, a recession that rivals anything that we have seen in human history, the last thing that people typically would go out and do is spend on their house or get a new house or buy a car, because these are the most durable of consumables. Housing is actually investment, but let's think about it as a consumable. The large lumpy stuff is usually those are the first things to drop off the list. And so that was a clue to us that people were not nearly as worried about the long-term future as some of the press inflammatory stories would have indicated at the time. This is just not usual behavior. And so the auto sector rebounded really quickly. And this is one that knows how to shut down. They have shutdowns pretty much every year for retoolings or new models or what have you. So they've got really well-honed processes in place to be able to do this kind of thing. So they shut down, they came right back on again, almost entirely in sync with each other. And they were doing famously until they started running out of supplies. And so this chip thing makes it look like the auto sector is not doing very well, that, you know, this is just a flurry of activity and now it's sort of on the wane at the moment. Ooh, you know, what's happening to the auto sector? It's all supply driven. The lot inventories of highly sought after vehicles are perilously low in the United States. You know, if sales continue for the next month, you know, some lots just aren't going to have any equipment on them. And that's a crisis, because if people want to buy, you know, you want to have the product actually there. Well, there's nothing like that kind of signal and a bit of price movement on the chip side of things to up the production and to get things going. There are some short run considerations, not just in the chip industry, but also in terms of the availability of shipping containers at the moment, that are very temporary and are being worked out at the moment. So I don't expect this to last more than another month or two. But over that period of time, it's going to be pretty hard to get a vehicle. I've got my dealership saying, hey, you got a 10-year-old car and we're going to pay you 10% over market because we've got lots of people that want it. And it's like, when has that ever happened before? You know, this is just an unusual period of time. And by the way, I don't own a collector's item. Like, this is just a regular car, okay? And that's what they're saying, because there's just a crying need for actual volume at the moment. I don't know what they think I'm going to replace it with, but whatever. That's where the auto sector is at the moment. That's how we put that into context. And you know, we're certainly hoping that there is a quick resolution for this. Company information that we get indicates that that will be the case. But if not, watch the prices of these inputs really take a surge. Dawn, I don't know if you've got any more you'd want to add to that.
No, absolutely agree with your take.
I think we're closing in on some of the last questions. Dawn, this one I'll turn to you. The question is, commercial construction is moving ahead fairly robustly. How does this activity align with the unknown of how back to work rolls out?
Yeah, I mean, you know, when we're thinking about back to work, and this is where it seems that employers and employees in many cases are quite far apart. You know, employees saying, well, you know, this is kind of good. I'm good. I don't have to commute. I have control over my schedule a little bit more, and I'm just as productive as I've ever been. Where employers are like, yeah, but what about creativity and the fact that, you know, we can collaborate and we need to, you know, work together and be on premises. So as we look forward, you know, it's likely to be some kind of hybrid model. Now, for some companies that have a huge footprint, it could mean reducing some of their space. They may have desk sharing. They may have that hoteling type of idea come into place. But the other thing is, and it's all to Peter's idea of hope and expectations, you know, are people going to be as comfortable being in these little cramped, you know, desks that we just came out of? Are we going to need more space? So I think, you know, if we do agree that there will be times when people will be in the office, that not everyone's going to be, you know, 90% in their home and only 10% in their office, you know, it's still going to be demand. And so I don't know that the shrinkage of the footprint for a lot of companies is going to be that much different. We will have people who will want more space around them, you know, want the 6 feet everywhere in order to feel safe to be in the office. And I do think that we probably are going to see people going back. A lot of people, you know, when you think about like new workers, for example, young people, you know, they're definitely going to want to get back into the office, I would think, just to make connections. As Peter was saying, you know, we've got screen fatigue. I think we are going to see, you know, so I guess overall what I'm saying is that, you know, demand for office space is not going to be eliminated. I don't think it's going to be remote work for the majority of people for the majority of time.
I think one of the things I could maybe chip in on this is that neither Dawn and I don't think Dawn is, but I certainly am not a psychologist. And this is really the realm into which we're going. Like, what is going to be the psychology of the return to work? Is it going to be that people that are now operating exclusively digitally don't actually see the nuances of human behavior? They're not getting the little signals, the body language stuff that goes on inside of meetings. Are they going to feel alienated from the people that are actually locating in an office? And those kinds of considerations are ones that are going to be fundamental to whether we're all rushing back in because we don't want to be outside of the game that's going on, or whether we can actually operate in this way. Right now, we all are forced to work this way. So we're all on a level playing field. It's when that playing field gets a little bit tilted in the return to work, my leanings are we're going to be drawn back into that. Just like we were in the post-SARS period as well. There were lots of pronouncements about, I don't want to be close to anybody. If this is an airborne, breathable sort of transmission process, then, I can't see myself going back into the office. That rhetoric was there. It just didn't last as long then as it has this time around. So that could play a role in how we go back. But I think the dynamics of this, again, I shouldn't even be opining on this because I don't have expertise in this area, but just I'm sort of being the armchair psychologist right now and saying, there's something about human behavior that leads me to believe that we built those office towers in the past for a reason, and those reasons are going to be quite abundantly clear when we get the green light to go back in.
Thank you, Peter and Dawn. Great insights. We're nearing the end. We're actually still getting some questions from the audience, and I want to say thank you very much. The audience has been fantastic. Great questions. There's a couple here I will not be able to get to. I wish I could. I'd like to give you both just a minute each, just to kind of give us maybe some wrap-up comments. I know it's not a long time, but do you have any advice on the topics that we've talked about? Maybe just some main advice for some of the businesses out there. And Dawn, maybe we'll just start with you.
Yeah, I think it's easy, and we're all guilty of it. Is you get very nervous when we see these case counts rising. But I think it is keeping sort of your eye on the forward looking. You look at surveys, and often you'll see the 3-month outlook, people are feeling very down, but the 12-month, that optimism is evident. People realize we're going to work our way through it. So I think it is just trying to manage today, but realize that the vaccines are, even if they're slow, they're coming. The economy is going to get back on its feet. The supports are there for us right now, but the momentum will pick up, I think, quite significantly as we go through the second half of this year.
Thank you, Dawn. Peter?
I would just say 4 words: fasten your seatbelts. The Biden stimulus is going to come in like a torrent. Folks, what Dawn and I have both said is that we have had to adjust our forecasts up by more than we've probably ever done in our lifetimes. The OECD has done the same. The Federal Reserve Board had to up their forecast by 2 percentage points from December to March. So understand, there is this pent-up wave that's going to come across the economy like a tsunami. And don't take it from me, take it from the OECD. They're saying, look, $750 billion of that 1.9 trillion is being spent in this quarter that we're in right now. So if you're not feeling it now, it's coming fast and very soon. And so I would say, with all that's going on right now, with all the concerns that you might have about how responsible that kind of spending is, you're going to get lost in the fact that growth just needs to be facilitated at this point in time. Now, some have said, yeah, but Buy American, they're going to keep it all themselves. The OECD thinks, yes, they're going to get the bulk of it, but Canada is going to get about a 1 percentage point on GDP boost, additional to what we were already going to get as a result of all of this. So, that's been woven into the comments that Dawn and I have made, but I can't say in more emphatic terms how ready we need to be for what's going to wash across, because even if the US tries to keep it all, they don't have the capacity to keep it all. It's going to spill over their borders. So I would say that's the immediate concern. Get ready for this, because if you're first in line with capacity to be able to serve this, people are going to sign up for the things that you are selling.
Thank you, Peter. That's wonderful. And we're at time. I just want to take this opportunity to say thank you to Dawn, thank you to Peter. I've enjoyed my time. I hope the audience has enjoyed their time. Thank you for all your insights. I do want to say a big thank you to the team at the Vaughan Chamber of Commerce, most notably Jennifer Coletta-Rashti, Abdus Samad, and Brian Schiffman as well. On behalf of myself and on behalf of BDO Canada, thank you for all your time, and we hope you've enjoyed it. So that will conclude our Economic Summit for 2021, and enjoy the rest of your Friday. Thank you.
Thanks, Louis, and thanks, everybody.
Thank you. Mm-hmm.